Well, welcome everybody to this great event that we worked hard not only to be able to work with two great partners for our firm to building out this emerging growth strategy, but also to be here tonight. So I thank everybody for taking the time to drive here and spend the night. I know it's not the greatest night to be here with all the fog and the rain, but you made it here. So we're all very, very happy that you made it here tonight. So three key things that I want to talk to you about. Number one is, the great thing about all of us being here today is not only learn about what Mark has to say, but more importantly is this community that we built for our clients. The great thing about this community that we have is that everybody can network with each other, get to learn from each other. Many times clients ask me, Phil, do you know of a client that could help me with this or that? Or I have a client that I'm selling this business or looking to buy that business. And oftentimes I can connect them. So because of this network and community that we built together, it's really helpful for all of us. So take the time, before and now after this event to get to know each other. Those that are prospects that are thinking about being a client of the firm, take some time to speak to some current clients to get acclimated what we're all about. So the first part is community, which I think is important for all of us. The second part is to help you understand what's the story behind why we're even up here. How do we even get here? So when I launched my firm 4 years ago, I said to myself, right, the first chart that we'll show here is the chart on the QQQ versus the S&P 500. So when you look at this since 2000, or really 1999, QQQ has outperformed the S&P 500 by double. And then you look at the next chart, which is the biotech index. The biotech index since 1995 has outperformed the S&P 500 by double. So being in the business for over 23 years, I've always recognized this, and I said to myself, when I finally launched my own firm, I want to build an emerging growth strategy where I can find two managers that specifically focus in on technology and biotech that could assist our firm in building out this strategy and provide us with the investment ideas that we need to be successful and be able to provide this level of performance for our clients. So that was the mission that I had. So we went on this mission together as a team, and we interviewed several professionals in this particular areas. We spent tons and tons of time interviewing several people. And to keep it really, really short, the bottom line for me is that when I met with both Mark, and I wish they could change one C to one Mark K, the bottom line is that we met with them, we spent a lot of time with them. We had dinners and lunches, several Zoom meetings, face-to-face meetings. And what I recognized right away is that there's such good people, salt-of-the-earth people. And that was really number one and most important for me, especially when it comes to entrusting my clients' money, right? So that's number one. And then number two, which is obviously equally important, is performance. For example, Mark Weiss of Open Field Capital, his performance since 2006 has averaged 14.44%, while the NASDAQ has done 10, and the S&P has just done over 7. So significant outperformance over a very, very long period of time. So I was like, wow, that's impressive. Then when I looked at Mark Pentopoulos, who went through performance numbers, since March of 16, since he launched his hedge fund, his long-only ideas, which we only care about and we utilize, since March of 16 has averaged over 20%. Now, past performance is not a guarantee of future results. We all know that. That's kind of compliance-wise, it's something that we all have to say, but that's interesting to me. So the third thing that was really interesting to me is that they were going to be a real resource to me at any point that I need them. Text, phone call. So we have monthly calls together besides additional calls either with clients. We have clients that have positions in NVIDIA, for example, and they're concerned about the rise in NVIDIA, what they should do about that particular position. So we got Mark Weiss on the phone with these clients, and then he helped them along to make a decision. Should they buy, should they sell it, should they buy more, or should they hold on to it? And it's been an incredible resource for my clients. And the same thing with Mark Pentopoulos. Now we as a firm and you as clients have them as real resources. And these are guys that are fully engaged in these areas. All they think about and breathe are these particular areas. And that's exactly what I needed. So what we did essentially is we built this emerging growth strategy where 50% of the strategy is Mark Pentopoulos, 50% is Mark Weiss, so it's half tech, half biotech, all in one particular account and strategy. It consists of individual stocks specifically. So my mindset has always been, as all of you know, as you and my clients, and what I talk about all the time, is that we own a core bunch of individual businesses that share three characteristics. Number one is stable earnings over a 15-year period. If a company has stable earnings, then they could throw off a lot of free cash flow. And if they throw a lot of free cash flow off, then I, as the portfolio manager, could understand how management takes that capital and reinvest it back into the business, and I want to see investment capital returns of something north of 10%. Because if you think about the rule of 72, if you can grow any type of money by 10%, you double every 7 years. So a manager that has returns on invested capital of north of 10%, that'll help increase shareholder value, and ultimately that's the core of what we're doing for our clients. So that's 85%, 90%. So where do they fit in for you? Because the thing about their strategy is there's a lot of volatility and a lot of risk. So 10 to 15% is probably a good number to counterbalance the core part of their portfolio. So just to go to the next slide here from Mark Weiss. So Mark Weiss, in further analyzing this crazy slide you see here, which I didn't want to show you, but I wanted to talk to you about it, is that out of 38 technology managers that are out there, over the course since Mark started managing money, Mark has outperformed every single one of them. Because that's one of the key criteria we do as someone who analyzes portfolio managers. We always assess them relative to other portfolio managers. So that's one of the key things that we saw here. So if you go to the next slide, Matt, this gives you an idea of Mark Pentopoulos' results on that mountain chart relative to the various indices that he follows. So for me as a money manager and hiring money managers, these are the key things that we look at, and that's how we got here today. So it was important for me to share that all with you. So what I'm going to do now for the next, hopefully call it 30 minutes, what I tried when we had this conversation with Mark, one of the key things that we talked about, we want to make sure we keep everybody fully engaged as much as possible, right? So the key is to talk about a particular topic and keep it at a level where everybody can understand it. We can peel back the onion as much as you want through Q&A, and we have no problem with doing that. So I'm going to get into now interviewing them what I think are key questions that all of us should be thinking about as potential investors in these particular areas. So Mark, thank you for your time today, guys. Appreciate it. Always a pleasure having these types of talks. All right, so the first question I have, and Mark Weiss, I'm going to start with you. So why does it make sense to invest in the technology sector as we think about the next 10 years?
Well, it's technology is, as you can see from this chart, technology comes in waves. And so when you think back in time to 1970s, 60s, 80s, it was a mainframe era. And 1980, IBM was the most valuable company in the world. But 6 years later, Microsoft is going to be coming public, and all the rules are going to change. And so you see in the graph in the 1980s and 90s, you had multiple technologies, different technologies, but they were complementary and they self-reinforced. And we call this megatrend reinforcement. So you had the PC, which was great, but then you also had the networking piece, the stuff that connected PCs to servers. And those three things combined created a whole new set of companies, and it took all the application development out of the mainframe and into these new apps, and he created big new giant companies, Cisco, Intel, Oracle, SAP. Now, after that period, we have what I call Internet 2.0, and it was really the introduction of the device went from the PC to the mobile phone. So we had the mobile revolution, right? And that created Apple, but also it helped Google and Android. You had the cloud computing. You took computing out of your data center, you moved it into these shared cloud data centers, and that created not just great market caps and things like Google and Microsoft, but also Salesforce.com, ServiceNow, Workday, and about 20 other SaaS companies that have all performed very well. And now we think we're at the beginning of a new wave of tech. That's going to be, again, was complementary, self-reinforcing big tech trends. And those we believe are AI, augmented reality, robotics, autonomous vehicles, electric vehicles. And we think those trends are going to create the next great big tech giants. And so if you want to make money, you want to be in the new trends. It's like, as Bill was saying before, it's like mid-'80s, early '90s. That was the time to get into Microsoft because that was going to replace IBM.
Excellent. Mark, let's talk about your sector, right? So as we think about over the next 10 years, right, why should we be an investor in biotech, life sciences?
Well, first of all, the demographic trends really favor for healthcare right now. Aging population around the world, really. So it's a key component. The other thing is that we really are getting to the point where we understand the human body, and so we can really make targeted therapies. We've just recently had the first genetic editing drug approved, where literally you inject the machinery into a patient and it fixes their genome and fixes their disease. So we're just on the cusp of major innovation in terms of curing genetic diseases. And another thing is that pharmaceuticals are really facing a large patent cliff on a lot of their existing medicines, and will probably lose about $170 billion in exclusivity over the next 5 years, and with additional beyond that. So they really are looking to these smaller companies for the next wave of products for them. And so I think those three things kind of put us into a really interesting time. And with the sector having corrected quite a bit over the last 2 to 3 years, I think there's some pretty compelling opportunities now to take advantage of good pricing on a lot of this innovative development that's been occurring over the last 5 years.
Yeah, so it's like so technology obviously has a really nice run of recently, and obviously biotech is off about 40-50% off their highs. Some businesses are down even more than that. So as far as M&A is concerned in your sector, because we've seen such a depreciation from its peak, right? What does that look like to you as you think about the future?
Yeah, so it's funny, when the sector's really hot, M&A slows down because pharma looks at it and says, well, we can't afford that anymore. But then when it corrects, you see M&A kick up. And so, last year in 2023, we saw about $70 billion worth of M&A occur. I expect, we'll see continued M&A this year and next year because they need to fill these patent gaps that they have. So, it's a kind of seesaw a little bit, when the sector's hot, there's less M&A, but when it comes back down, you see more M&A. So it's kind of a healthy kind of equilibrium that kind of occurs. When the M&A happens, it tends to kind of reinvigorate some interest in the sector, and that usually, when the pharma company's buying all the biotech stuff, that's usually kind of a sign that, we're close to the bottom of the sector and we should see another leg up in the sector.
As far as biotech takes such a big hit, a lot of that was due to a rising interest rate, right? So the cost of capital. So could you talk us through that? Why was there such a big hit to the biotech sector?
Yeah, there's two reasons. One is because zero interest rate environment created a lot of speculation in the sector. So, with 0% interest rates, you get no money in the bank, so you gamble with the money. And so therefore, we saw a lot of biotechs go public that were, not 5 years from the market, but 25 years. I mean, these were science experiments that were going public. And so you created a lot of froth. There's a lot of capital that went into the sector. And what happens when interest rates go up is, the weighted average cost of capital goes up, and, people can go, actually I can get, a 5% on my in the bank for my money. So, maybe I don't need to speculate on biotech. So you kind of had a confluence of a bubble that had formed in biotech as well as rising interest rates. And I think those two kind of provided a 1-2 punch for the sector. And as a result, you saw the sector down 50%.
Thanks, Mark. So Mark Weiss, I want to get back into artificial intelligence, right? So we all have been reading about artificial intelligence. We've all been reading about ChatGPT. So how many have used ChatGPT so far and actually tried it out? Actually more than I had thought, which is excellent. So Matt, if you can get to that point. So the key thing for me with artificial intelligence as an investor, right? I tried the technology, now I utilize technology for business. Now I'm saying to myself, okay, well, how is it really going to help increase productivity with business, number one, and how is it going to increase earnings for companies? Well, the first thing is that when you go to ChatGPT, what we did here is we typed in, build a practice plan for starting a dental practice. So when you put that in there, let's see what comes out. It starts firing out a whole host of things, that everything you need to do if you want to build a business plan for starting a dental practice. I mean, that's how amazing this technology is, which is something that we've never seen before. The difference between going to Google for all of us, we go to Google, we type that in there, you have several articles you have to sift through, and you have to kind of figure it out yourself, more or less. Some great articles out there that could help you, which is terrific. But with this here, it takes everything from Google and just kind of gives you the answer. And that's, for me, which created, it increased productivity for me and what I do day to day, which has freed up my time, which is always helpful. So Mark, right, when we look at ChatGPT, we think about AI, and you and I have talked about this numerous times. How is this going to increase productivity in your mind?
Well, I think it's it saves an enormous amount of time, and it's very, very broad horizontally. We just saw in the last week a there's one of these startups in Silicon Valley getting $1 billion valuation because it's literally and the term you're going to hear is the word co-pilot, something that's going to help lawyers be more productive, help them write their contracts faster. You're going to see for doctors, we're already seeing that the AI is getting just about as good as where a doctor is and be able to make a correct diagnosis. That's now. 5-10 years from now, I imagine you're going to see not only parity, but perhaps superiority. And again, it doesn't mean you replace the doctor. It's just going to make the doctor able to get to an answer faster. Because the wonderful thing about these very large language models is they literally can ingest all available data. My brother, who unfortunately passed away, was a urologist, and he was a very good urologist. There's no way he could read every article in the journal of urology. Right. And even if he did, he could not have perfect recall of it. But the AI can. Right. And the AI can also read all the other journals and understand when a condition manifests itself across not just your specialty, but someone else's specialty. So, and when you like, we all get excited about self-driving cars because that there's 30,000, 40,000 people die every year on the highways, and maybe we can get that to zero. I think it's 200,000 people die a year in the United States from medical errors. So just in that one area, you could see a huge increase in productivity, getting to the right answer faster, and avoiding mistakes. But the thing is it affects, we think, every sector of the economy, and it can really boost our productivity, which unfortunately has been a lot slower than you might think. We all think these smartphones are great, but the productivity numbers aren't that good. And so...
So Mark, what I want to talk about, right? So you and I have talked about this. Talk about past technology and what that's done for business. We talked about kind of back office operations enhancements, and talk about this current technology, AI, and the difference being there on the front line.
Well, it's, I would go with that it's just very broad horizontally, and that it's going to be capable of restructuring industries. If you really think about, cloud computing is a very interesting example. It increased the productivity of IT, but there's, I don't think we've had a massive increase in productivity in the healthcare sector or the education sector for that matter. In fact, the college education costs are rising faster than inflation because you have to keep paying higher salaries to attract people from productive segments to teach at a university with the same student number of students to teacher ratio. But with AI and generative AI, maybe we can get to a point where a college degree costs $10,000 instead of $500,000 with the same level of knowledge transfer. So it's about the ability to totally restructure industries. That exists, we think, with AI far more than it ever did with past IT type technologies. So we think it's going to be a much, much larger impact.
Right. I just want to touch on this because we're talking about all positive things about AI, right? So we talked about in terms of the negative parts of AI, the learning language models, the cost of that, the time, right? So there are negative things about AI that may take time to get it off the ground.
True, absolutely true. And there's the cost of AI is enormous. There's actually a very good article today, and there's an OpenAI lookalike company called Anthropic. And we just got the data today that their gross margins are only 55%. Now, an enterprise software company has gross margins usually between 75 and 80. So why are their gross margins so low? Well, because they got to pay an arm and a leg to NVIDIA to get the GPU chips. So it's enormously expensive. And it's also a problem of power. These chips consume enormous amounts of power. Sam Altman was at the World Economic Forum saying we need a breakthrough in nuclear energy to power AI. And, well, I want AI on my smartphone. This, your brain, 20 watts of power. And we can do things that data centers with racks of equipment and a nuclear power station with megawatts, we can do things that can't. So I think we're very early in this AI thing, and this current wave is great, but there's another wave coming, which is going to be much more power efficient. It's going to be much more like our brain. And there's already private companies making very good headway in that direction. So NVIDIA's great, Microsoft's great, they're doing great things with AI, but there's another wave coming.
Right.
And that one's going to be even more promising.
Right, which we're going to talk about. So big concern that all of us have as investors is the debt levels we have and the deficits we have in this country. And we're all wondering, how do you really solve these debt problems? And some of the research out there about the increase in productivity with AI and how much it can enhance GDP, which can slow the percentage of debt to GDP over time. So AI can be interesting as it relates to our debt levels and maybe even reducing it because of increasing GDP over time. Could you just quickly touch upon that? Because I need to get to Mark on the next question.
Sure. There's CBO reports out there which are great, and they show what productivity growth has been, say, since World War II. And if you look at the period from like the 50s to the 70s, from 1950 to like 1973, it was 2.5% a year productivity growth. And if you think of GDP growth is how much labor you have and how fast does your productivity grow. And the problem we have now is our productivity growth is only about 1.2, 1.5% a year, which is better than the 70s was 0.7. It was a disaster. Now it's better, but we have very little population growth. And so our debt is growing much faster than our GDP. So if we want to fix it, we got to get GDP growth up. How are we going to do that? Has to be increased productivity. And there's literally graphs you can find on CBO reports, and they show, well, if productivity was only 0.5% a year faster than it is, which is significant, going from 1.2% to 1.7 is a 40, 50% increase, but you compound that over 20, 30 years, then our debt will be a much more manageable level than where it's projected to go, which is kind of, if you look at the projections, don't look at them, it makes you very depressed. So, but I think we have a good reason to hope that the productivity boost is going to come, and it's going to really save our bacon.
Mark P. So what I found most interesting about being a biotech investor, right, and I think the most challenging is, so you've been through the whole FDA process with the patent for your prior pharmaceutical company. So how difficult is it to get things done through the FDA?
It is difficult. I would say certain drugs are much more difficult than other drugs to get through the FDA. I think, though, that if one has a good science behind the project, if the data suggests that the project is safe, that'll get you into clinical studies. And then if your data pans out and you show good safety, your odds of being approved, if there are no other treatments for the disease, are quite high. So I think it's one of those things that just has to be managed well. And if as you analyze investments, you really need to talk to that strategy with the management team to make sure that they have a good sense as to whether they're going to be able to get a project through the FDA. You can often look at the disease and look at the way that they're designing the study to get a good feel as to whether that management team really knows what they're doing or not. And, unfortunately, in my sector, there's a lot of kind of promises that never get fulfilled by many of these biotech companies. And I think it is in understanding their interactions with the FDA and understanding how they're designing their clinical studies that you will see the flaws, if there are going to be major flaws in that company.
Mark, how do you see through those management teams that are putting out big promises that they're not going to be able to fulfill? With your experience, how have you learned to?
Well, you ask them a lot of questions. You ask them questions that you don't know the answers to, and you ask them the questions that you already do know the answers to, and you kind of you get a sense as to one, how confident they are, and two, how they've thought through their regulatory strategy and their clinical trial strategy.
Excellent. So, what are the key themes, Mark Weiss, that you see that investors should be paying attention to? One of the things that Mark Weiss and I have talked about several times, and I've asked Mark, is, Mark, how do you come up with these themes? How do you start to really identify these themes? And I mean, his answer was just phenomenal. He said, Phil, he goes, I look at what the bigger companies are doing and where they're spending their money on, and then I go out there and look for actual pure plays in those particular areas. And that's how I identify the next latest and greatest theme. So if Google's placing a tons of capital in one particular area, that's not a big percentage of Google's business, you have to question, well, what is Google seeing that we're not seeing? And that's how he goes about finding some of his trends. So talk us through themes that you see going forward, which we touched on a little bit before, and what I just talked about.
Sure. And so, well, the first thing I'd like to address is this graph, which shows the top 10 market cap companies by decade, going back to 1980. And the ones that are colored are the ones that have been there more than once on a decadal view. And what you'll notice is most of them are white, which means once you're in that top 10 list, 10 years later, you're usually off the list. And so in terms of perception of what risk is, most people think the biggest companies are the least risky. Well, this data shows that that's not true. So in 1980, IBM was number one, market cap company in the world. And a bunch of oil companies, Eastman Kodak's number 10, we all know what happened there. 1990, that's the Japanese bubble. All these Japanese banks in the top 10, never happening again. 2000, Microsoft's there for the first time. Cisco is there, Intel's there. Those are very powerful companies. Where are they today? Are they trillion-dollar companies? They're $100, $200 billion companies. They're a shadow of what they once were. And so 2020, you have all these cloud mobile social companies. And what were they doing? Well, they're all investing in AI. They're all investing in augmented reality. They're investing in quantum computing. They're investing in autonomous driving, right? And the fact that Google investing in Waymo has not stopped Tesla from emerging. And much in the same way that Microsoft investing in search engines didn't stop Google from emerging. So we feel that these new trends that are, so we talk a lot about AI, but there's also things like augmented reality, quantum computing, robotics. These we think all can produce companies $1 to $10 trillion in value. And by the way, it's not just about finding those companies. There's going to be a whole bunch of other companies in the hundreds of billions of dollars of value created. But what we feel very good about is that incumbency and a lot of money does not determine success. If it did, IBM would have stopped Microsoft, Microsoft would have stopped Google, and MySpace would have stopped Facebook. And none of those things happened. So we have the very vibrant venture capital industry for a reason. Small teams, very focused, can outdo companies with 1,000 times the budget and 1,000 times the engineers. Sometimes the bigger the company, the more bureaucracy, it really gums up the works. So we just watch what the money is in, we watch what the venture capitalists are doing, watch what the big companies are doing, and we figure out what the trends are. Now, figuring out the companies, that's where we spend a lot of time on the privates. And we look at private investing as building a farm team for what you want to own in the public sector. Sequoia did a great job investing in Google Series A, but they got out 1 or 2 years when Google was still under $100 billion of market cap. Now it's in the trillions. So we think it's most of the money is going to be made in the public markets, but you want to figure out the companies while they're private. And if you get them right privately, great. If you get it wrong, you figure out who is going to win and you pick it up on the public side. But you've already done your homework. And you did it. If you see the prospectus on your desk and you go to the road show, it's too late. You need to know the companies 2, 3, 4 years before they go public.
Mark Weiss, how important it is to be plugged into a network in Silicon Valley to figure out, right, what privates out there that are going to be hopping on what we're talking about here, right, and then going public and being involved in that as an investor?
Well, it's absolutely essential. It's there's only so much you can do, and this is where, to me, you look at a lot of fields of endeavor where people do great things, physicists and scientists, a lot of the great work they do in their 20s. And I think when it comes to investing, it's the time and experience and finding peers that have complementary networks and experience, and you can really triangulate. I have a group of guys that most of them are billionaires, angel investors. We do 5-6 calls a week. We had our weekly call today. One of them was employee number 10 or 12 at Facebook. He built out their whole back end. One was the CEO of Veritas Software, the best performing stock in the 90s. Between all of us, we know 80-90% of all the top venture capitalists. We feed them deals, they feed us deals, but we get a sense for where things are moving next. And that is If you want to know where the puck is going, you got to hang out with smarter people than yourself.
That's where it's at. Mark P, themes that you see, best way to invest.
Themes for 2024, I would say I continue to see M&A activity happening. I think you're going to see the medical device and medical diagnostics sectors turn back up again, and some of the tools companies turn back up again after 3 tough years. I think M&A will creep into the diagnostics and medical device areas again. Medical diagnostics is such an important area, in terms of treating disease, because if you can spot the disease before it happens, you're in such a better place than waiting for the disease to actually show up. So I think that's going to be kind of a core theme for the coming year. And then look for the growth of AI in healthcare. AI is going to have a huge impact in healthcare, both on the design of the drugs, for the diagnosis of various diseases, and also in the way that we can better design clinical studies to get through the FDA so that we can target populations more accurately and have more focused drugs that have a higher impact on the patient, and kind of slowly mitigate the risk of a failed study by, identifying potential side effects too early, or not getting the right patient population in a clinical study so that there's a lot of noise and you don't get a clean result. So I think these would be some core themes, over the next couple of years.
What about Mounjaro and where we're going with that drug?
Huge. Obviously the weight loss drugs are huge. We're just kind of learning a little bit more and more every day about these things. I think, obviously they have an impact on things like, glucose levels. We know that there's a positive cardiovascular benefit from some of these drugs. I think as a lot of people lose weight on these drugs, we're going to see some of these autoimmune disorders start to go away, because a lot of diseases of autoimmune disorders are caused by bad diet and things like that. Just chronic inflammation in the body. It wouldn't surprise me if patients on these drugs, we don't find that 5-10 years down the road they have a lower cancer risk because of lower weight. So I think we're kind of at the cusp of really understanding where these the benefits are going to be. But I think if you're looking for kind of an interesting area to watch for, it's autoimmune disorders, and how do these drugs affect all these autoimmune disorders down the road? Because I'm absolutely positive that we're going to see less disease because of that.
Excellent. So, Mark P., I want to ask you, when managing money for as long as you have, right, and as long as you've been in the industry for, what are the key qualities that you've seen that made your stock picking the right business, a success? The top 2 or 3 that would be helpful for all of us to know.
So I have actually quite a simple process. It's basically, what's the market opportunity? What's the intellectual property look like? What's the competitive landscape look like? And then, what is the quality of the management team? That's really what I'm looking for. I'm trying to analyze that. And then it's really up to me to buy that stock at the right price. And so what I'm looking at is my downside risk versus my upside reward. And what I tend to see with technologies is you kind of get these waves where, there's a lot of excitement initially, and then it kind of wears off, and then then people go, oh, it really is big. And I think, if you can either get in right here or get in right here, you're in a much better place from a investment returns perspective than if you're getting in, at the top of the first wave, or you've waited for the thing to, everyone talk about it. So I think, and most likely, when you're buying it at these kind of troughs, you can often mitigate your risk by the strength of the balance sheet, the number of other programs the company has, things that would mitigate the risk if, for instance, something didn't go well with the lead product.
So, Mark, about the balance sheet, which I found very interesting when we talked about, so I was interviewing you. So just quickly about the balance sheet, what do you look at in a balance sheet that gives you a little bit of conviction to hold on to a particular business?
Sure. So I think, the question is how much cash do they have, right? Because, drug development is expensive. And commercialization is expensive. So the question is how much cash do they have and where can that take them? So for companies that are running out of cash, If something goes wrong, you really are looking at potentially a zero with a company. So you want to, make sure that there is a strong balance sheet. I think what's been interesting to kind of view, which I had never seen before, is looking at companies trading at less than 50% of the cash on their balance sheet. Well, you can go through, some of those companies are obviously not going anywhere, but some of them are going somewhere. And if you think about the risk reward that those set up, where they're trading at, less than the cash that they'll have on the balance sheet in 2 years' time from now, your downside risk is not that significant compared to your upside reward if something really good happens at the company. So, I always look at investing as a risk reward, right? What is the downside if I'm wrong? What's the upside if I'm right? And I'm always looking for a much higher multiple of upside return than downside loss on any investment position.
So Mark Weiss, right? There's a plethora of opportunities out there to pick from. You've been at this for a long time, right? From your experience, what qualities have you seen that have been the winning recipe to picking the right businesses? Top 2 or 3?
Well, it's management's always number one, but a lot of people say management, and a lot of that is something that's very subjective. To me, management really manifests itself in financials, and you have to see how companies have managed their cash. I'll give an example. There's a whole bunch of companies that look at all the logs of your routers, your servers, and it's all to try to make sure how to keep your applications up, and they analyze little fluctuations to try to predict problems or security breaches. And there's a lot of companies in that space. But there's this one out there called Datadog. And when they said it's like they were like the last entrant in the space. So no VCs are like, there's already 10 companies doing this. Why should we invest in you? So I think they only burned, I forget the numbers, like only $20-30 million in their entire life as a company, because they had to be super efficient. And so I don't have to like the CEO personally. I just have to look at you raised the least amount of money, and you've gotten the most number of customers, most revenue, best free cash flow as a percent of revenue versus all your competitors. That's by definition great management. So we try to be very, you don't want to fall in love with people. You don't want to have it be personal. You want to be brutally cold when analyzing the numbers and analyzing the history. But that's how you find good management. You have to really look at the numbers. And a lot of times also you have to look at, quite frankly, time. For instance, like the management team running, there's a company out there called Snowflake. It's a next-gen database. They've beaten all the big database companies. It's one of the hottest software companies out there. And the team that did it is the same team. We had invested him in Data Domain, had a great exit. Then he's ServiceNow. Is probably the best SaaS company out there, better than Salesforce, much more profitable than Salesforce.com. That management team built ServiceNow. And then this is their third time doing it. It's the same team. It's all the same people. It's just like, well, it's Frank Slootman and company. How can you not own it? You just know Frank is probably the best SaaS CEO out there, best software CEO out there, looking back decades. So of course you're going to invest in them. Then it's about finding what the right price is. And it's also, in the end, it has to be a big market. There's certain companies that are only going to top out at $1 or $2 billion in revenue, and there's certain companies going for a big enough market where they can get to tens of billions in revenue. And to make money, you really want a big addressable market. And so
management's big, addressable market is big,
and barriers to entry.
Barriers to entry is always big.
And like Snowflake as an example, Google. To build Google, you had to have the best database engineers in the world. Amazon they all have great database teams. How did Snowflake, a startup, beat the cloud guys at their game? I can't tell you how they did it. All I know is that they did do it. That means they have technology that those guys don't have, and that says a lot. So you look for those sorts of those kind of, I guess, anecdotes to really give you the conviction that, there's Snowflake can out-Google Google. That's not easy to do.
So next question is about risk. So the biggest question I have when investing in any type of these sectors is the risk of of blow-ups, right? The way I always looked at risk is there's this risk of which is called volatility, right? But volatility really is just volatility. That's all it is. But it drives emotion in investors, and because of that, investors make really bad decisions with their money. But the real risk to all of us, especially when you stop working, and it's what our firm focuses on, is the risk of longevity, the risk of running out of money, the risk of outliving your money, right? So, because one of the things, like if you asked me doing this almost 24 years, the number one thing people care about who are ready to retire or retire ready, the number one thing is maintaining their lifestyle. Everybody loves their lifestyle. Nobody wants to lose their lifestyle. Nobody wants to run out of money being burdened on their children. So that's the real risk. So this risk of volatility is just emotion. And I wish people would understand that more, because it would help a lot of advisors that do what I do to get more aggressive with clients' capital, to be able to grow it more, to reduce that risk of running out of money. But there is this risk of blow up, right? So blow up is different. Blow up is they invest in a company 2 or 3 or 4, and it blows up and your money goes to zero. Now, fortunately, they invest in 20, 22 businesses, 30 businesses to keep it diversified. But the question for both of you, I'll start with Mark P., how do you avoid blowups?
Focus on good management teams. Don't pay too much when you enter the position. And then it's about position sizing in the portfolio, right? So if you have a company where your downside is 20% if you're wrong and your upside is 300%, that could be a larger position. If your risk is down 70% and your upside is up 500%, you may have a smaller position size. So I think the strength of the balance sheet, the strength of the value of the assets, the quality of the management team, and then position sizing in the portfolio are key things. And then also monitoring the position. If the position runs 200-300% on you, you may want to take some of that off the table just to reduce the size of that position in the portfolio. So those are some of the things you can do to kind of mitigate some of the downside risk. Because I think when people think about volatility, they're worried more about the downside volatility than the upside. The upside volatility it's great, right? It's the downside volatility. Right. And so position sizing and then doing those checks in terms of enterprise value, strength of the balance sheet, quality of management. I think all of those things can help to dampen downside volatility.
And Mark P., you do a great job in that, trading around positions. I see what you're doing within portfolios, so you really do a nice job around that. Mark Weiss, how do we avoid blowups?
Well, you try your best to not get in, as Mark just pointed out. You try to avoid bad management teams. You try to understand the competitive vectors. Sometimes companies just get checkmated and they're not going to make it. However, what I would tell you is that that should be the smaller of your worries. The biggest risk is you sell your winners. And I'll give you a couple of examples. Amazon, back in 2002, was probably 3-6 months away from bankruptcy. And a lot of people were selling it there. If you sold it there, you should have been buying it there, because you made 10,000% or more after that. In Mark's world, one of the biggest companies for measuring DNA is Illumina. That stock came public, I think in 2000, it was $20. 2003, it was 95 cents a share. So if you bought it at 20 and you blew it out at 95 cents, you're down 95%. And then from there, it went to like $500, $400 a share. So selling your winners early is the biggest risk. And it's so you want to try to avoid the blowout. But if you're going to make a mistake, holding on to your losers longer is a far better mistake than selling your winners early. Because that's where, look at the top 10 market cap companies. Most of the value goes to a small number of companies. So, and by the way, all of them are going to have a moment where you're going to have doubt about it, where it has a major correction. When I started in the business, my firm was the largest shareholder in Cisco and Parametric Technology. And the first year I was working there, both stocks got cut in half. And I remember thinking, how are we going to survive? And it turned out that was the last best time to buy them. off that bottom, both stocks went up 20x. So it's challenging. There's going to be volatility, but just because a stock comes down 50, 70% does not mean it's a loser. You have to really live through the cycles and have the intestinal fortitude to stick with them, sometimes even when it's painful.
All right, so Matt, I'm going to skip to slide 14. So the last question I have for them, then we're going to get into Q&A. And really the whole title of this presentation is the next $1 trillion company. So I asked both of them to come up with ideas of what they think could be the next potential $1 trillion companies. So Mark Weiss, start with you.
Well, these are some of the companies that we have in our portfolio right now.
On the public side.
On the public side. And you'll notice is that some of them are under $1 billion or $1 or $2 billion in valuation. So one of the most important things is where are you getting in, right? It's NVIDIA is a phenomenal company, and so is Microsoft. But one is $3 trillion, and the other one's $1.5 trillion. If NVIDIA doubles from here, and their demand they're seeing is exceptional, it very well may double, or maybe 2 doubles. But that is many trillions of dollars of additional value creation. That's not the easiest thing to do. Now, I'll just give you an example here. There's this company there called Archer. It's an eVTOL company, which means it's electric. It takes off like a helicopter, then flies like an airplane. There's 2 out there that we think are very promising, them and Joby. And both of them each got $150 million contracts from DOD last year. That's kind of DOD saying, we want these guys to survive as a signal to the FAA, help them get them through. And so you're not going to see 20 companies in this space. There's going to be a couple. But what's really great about eVTOLs, helicopters are a disaster. Thousands of moving parts, many single points of failure. They're loud. No one wants them. These things are 100 times quieter, almost no moving parts. And so you're going to be flying these things to Manhattan, from Manhattan to the airport. We think it's going to be, Morgan Stanley thinks this is going to be a $10 trillion market by the year 2040. Well, I don't need that to happen. This is a $1.5 billion company. It's like a $5-10 billion a year market in helicopters. If we just cannibalize helicopters, there's a pathway for this company to get to 10-15 billion. If Morgan Stanley is right, this could be a company that's in the $100, $200, $300 billion range. So it doesn't have to be a $1 trillion company. It could be a third of $1 trillion, but you can make hundreds of times your money. There's not many companies that can do this. This is one of them. We think they're going to get FAA certification this year. It's not without risk. They do not have all the cash they need. They think they have enough cash to get the FAA milestone, and then they can raise money on their terms. So there is some risk in owning it right now. As with all companies, there's risk. However, if it works, this is look, you can get into Tesla as a $600 billion market cap company. This is a $1.5 billion. And we all know, as great as Elon is, and I love Elon, he has been wrong about when self-driving comes. He's been saying it since 2006. It's next year. He's been saying this every year for 7-8 years. Maybe with the current form of AI, it'll never get there. Maybe there's just too many corner cases to solve and you need a new type of AI to do it. You already have autopilot today on airplanes. They can practically get you to land. So where does autonomous vehicles happen first? It may happen here first because it's an easier problem. So we think of like a very interesting AI play, a very interesting EV play. It's not electric vehicles. It's electric airplanes, helicopters, eVTOLs. So again, it's just an example of something that's people don't know about it. You can't fly in it yet, but there's going to be, I think, at the Olympics this summer. You're going to see like one of these Chinese companies going to have something flying around in Paris. But watch Joby, watch Archer. Put them on your radar screen and watch them for the next 2 years. We think there's going to be something very big there.
Mark P.
Well, we don't actually have a $1 trillion company in healthcare yet.
Right.
So we have some that are marching and on the way, like Lilly and Novo Nordisk with the weight loss drugs, and continue to expect that those drugs will continue to grow. And as I said, as we see added benefit of these drugs in other diseases, I think the adoption and the acceptance of these drugs will just continue to grow. I think if you're looking for potentially the $1 trillion opportunity down the road, it's going to be in the confluence of technology and healthcare. So basically the confluence of AI, machine learning with designing drugs, designing clinical studies, diagnosing diseases. And there's a number of companies that are using AI now for small molecule design and antibody design and peptide design. And I think that we'll see a lot of promising things come out of those companies. With this sector, given the amount of money it costs to actually develop a drug, it's quite possible that these companies will be scooped up by large pharmaceutical companies. However, if they're able to have a number of successful hits and raise a lot of money, then they may be able to just decide to stay independent. So there's a few ideas that we have in the antibody space and the small molecule space, and we'll continue to see how they develop. The next big thing will be with AI and clinical studies. We're not there yet, but envision a day down the road where we don't have to run clinical studies because AI can predict exactly what the drug will do in the body.
I got to give us one or two ideas. Your best idea right now.
Yeah. So if we're looking at AI with regards to small molecules, the lead public company right now is Schrödinger's. And if you're looking at AI with regards to antibody technologies, I would say the lead company is OmniAb. I'd say those are two leaders right now in the use of AI in developing novel drugs.
I think the first one you said was
Schrödinger's.
So we're ready for Q&A now. So Mark and Mark, thank you for that great interview. I appreciate it, guys. You guys did an excellent job. All right, so Q&A, just raise your hand and we'll have the mic come over to you.
Hey, Phil. Hey, Mark. And Mark, thank you very much for your insight tonight. My name's Ricky Sinelli. I actually work for Biotechnology. So, Mark, I related a lot to what you were discussing tonight. I wrote down a question that I have for you that really raised my eyebrows. How do you feel the energy supply issue to create NVIDIA cards will impact the smaller companies looking to grow when you have Meta and other larger companies purchasing these things at like $350,000 a clip?
Well, we think there's the market is perceiving right now only the big guys can afford the check to buy all those GPUs. So we think there's two things are going to happen. First, that the architecture is going to change. So there's a company. It was actually in the news today that's working with the government on AI. It's called Cerebras. They have an entire wafer as a chip. Usually, you break up all the chips on the wafer and you put them on boards and you spread them out. And the problem is when you do that is the chips are not utilized. So when you get 100,000 chips in a data center and you're training one of these very big large language models that take up to a year to train, most of the time the chips are idle. They're waiting for information from another chip. The chip itself is only maybe 10% computing. The rest of it is it's storing data because the way you can move data between chips is it's like 1/10 the speed of moving data on chip. So Cerebras, by having this giant, all the memory and all the cores on one giant wafer, has huge outperformance versus NVIDIA, which is why this is a company like a year ago, they had almost no business. Now they have $2 billion in backlog, and we're pretty sure they're filing the area. We've been an investor in them for the last 5 years. But beyond that, optics is going to be a very big thing. If you can connect all these chips optically at 100 times the bandwidth of on-chip, then you're going to open up the door to a whole bunch of other new chip companies. And we think that's going to put a lot of pressure on NVIDIA. So NVIDIA's great right now. They're doing extraordinarily well. But when you think of the 350,000 chips that Meta's ordering at $30,000, that's $10.5 billion. 9 billion of that is wasted silicon. You're buying the highest, most expensive silicon from TSMC, and most of the time those chips are idle, and most of the chip is not even doing computing. It's storing data. If you get a terabit a second off the chip, then you don't need all that cache. You could take that ratio of 10% of the chip doing compute to 60, 70%. So the chip is 7 times more effective, and the chips aren't idle because they're all talking to each other very rapidly. So the economics, we think, are going to change very quickly here. And that's, again, one of the reasons why we always tell people first mover advantage is the biggest myth out there. IBM invented relational databases. Oracle made the money. Xerox PARC invented the GUI, Microsoft made all the money. And yeah, NVIDIA's first here, but they have a graphics, there's graphics where they started. They have not made an AI purpose chip. Those companies are still private. They're going to come public, and then it's going to be a much different game.
Good job, Mark. Next question.
Just real quick as a follow-up, the wafer that you're talking about how many cores or engines are expected to be produced
it's thousands of cores.
On one wafer?
On one wafer. And it's, like if you read, they had, you go to Cerebras, look at their blog post today, they're literally saying, we can train, the training a neural network can take a huge amount of time. They're saying they can train in days what it takes NVIDIA months to train. So imagine that company when it comes public. Right now, the company, its last round was valued at $4 billion. NVIDIA's at $1.5 trillion. What do I want to own? I want to own Cerebras. I don't want to own NVIDIA.
Absolutely. Thank you very much, Mark. Appreciate it.
Good question, Rick.
Yeah, we've all heard about the glories of AI, LL, and so on and so forth. I'd like to ask both of you a question about the potential negatives, and specifically I'm thinking about accidental, also known as hallucinations, and deliberate, in which AI, et cetera, are used by people for the purpose of deceiving. I'm interested in two aspects, two consequences of that. One is the damage to us individuals, of course, but the other one, which is more in the context of this meeting, is the potential hindrance to the adoption, the development, the acceptance of all of these advanced tools, AI, LL, and so on and so forth, because people will become skeptical and therefore stay away from it, as it's happening right now with electrical vehicles. Hertz is getting rid of 20,000 electrical vehicles. Why? Not because of any ideology, but because people don't want them. So here, my question, and I don't have the answer myself, of course, is how would people might reject AI, LL, etc.? Thank you.
It's an excellent question, and I think it's just what has to happen is AI has to continue to get better, and so the hallucinations is clearly a problem. And actually, it was funny. There's Bill Gates interviewed Sam Altman. It was posted on the 11th of January, so it's pretty recent. And it was an interesting interview, a very short one. But Sam Altman goes, what we thought with AI 10 years ago was that blue-collar work would get automated first, then white-collar work, and the last thing that would ever get automated would be creative things. Because that's what makes humans special. It's mystical. And he goes, it turns out it's the exact opposite. The first thing that's actually being automated is like creating images, because hallucinations, I'm quoting Sam here, is a feature there, right? The ability to make something up makes the creativity of AI really exciting. But yes, it has to be the numbers. The numbers have to be there. So you can't, perfect is not necessarily what you have to be, but if you're going to do self-driving, you got to show that you can create far fewer accidents than humans. That, I think, will be good. Perfect, I don't think anything's ever perfect. We're not perfect. Nothing is ever perfect, but it has to be materially better. And one of the things that gives me optimism is Google, just I think 2 weeks ago, announced a very big movement forward in terms of neural networks understanding math. Because the hallucinations is a big problem, but there's also like GPT-3, GPT-4, they will get basic math wrong. And you're like, how can this thing be so great at other stuff, but doesn't understand math? And we're now seeing the neural networks are making progress there. So I'm optimistic that even the current form of AI, which I don't think is the long-term one, will continue to make big advancements. But you have to convince people. Like if you're going to use it to diagnose patients, you have to show that it is materially better than a doctor on its own. And if you see that, well, then you'll adopt it.
Did that answer your question?
Yes.
Yeah. Okay. Good.
Anything that you'd like to add?
So the question was around the drawbacks of AI with, I think in most of the areas that we're looking at the applications of AI, it's in the design and diagnosis of diseases, and I don't necessarily see the negatives there. I mean, there's obviously, I don't know how real it is, but there's the fear mongering around using AI for synthetic biology in a way that could be used to create foreign organisms, essentially, right? And what that could be. I think it's hard to predict where that would go. We can do a pretty bad job with that without even using AI, as we've seen in the last few years, just by simple manipulation of certain organisms, that you can cause a lot of problems. So we'll have to see. But I think it's really up to the government, I guess, in many ways to try to regulate that. But I guess we'll have to wait and see. It's hard to predict that. Obviously, we hope that they allow the AI for good usage, and good usage really comes down to better design of drugs, better diagnosis of diseases, and better treatment algorithms for treating patients.
Excellent. Thank you, Marcus. Next question.
Quick question. It takes enormous amount of energy to mine Bitcoin. I would imagine that AI is going to take even more. How are we going to run this stuff with woke windmills and solar panels? Or do we have to go to green nuclear?
Great question. We're big believers in nuclear. In fact, we invested in a private company called Oklo, and Sam Altman's SPAC is in the process of acquiring it. The ticker of the SPAC is ALCC, and it's a breeder reactor, and which is the wonderful thing about these new types of reactors is, first of all, they're cheap because they're manufactured, they're not assembled, and all the nuclear waste, the first generation reactors, that's the fuel. Oklo is pretty sure that they're going to get paid to take the waste off the hands of the old guys, and they said that in the current nuclear waste we have out there, we have 140 years of electricity for the entire United States, just the nuclear waste. So that's how great that stuff is. But yeah, Microsoft's saying they need nuclear to power their AI data centers, and so is Sam Altman said we need a breakthrough. I think they're going to be proven wrong. I think the current AI is extraordinarily energy inefficient. I think we're going to figure out how to reverse engineer the brain. It's a very different architecture. GPT-4, which is their current one, is 120 layers of neurons and a bunch of a trillion synapses connecting them. Your neocortex, 6 layers thick. The connections between all those layers are almost all feed forward on neural networks. Most of your connections to your neocortex are more feedback than feed forward. This is a very different architecture. Neural networks, they're just were invented in the 1980s based on 1950s neuroscience. So we're learning a hell of a lot more about neuroscience. And a great book, it was actually one of Bill Gates' must-read books from 2021, was a book called 1,000 Brain Theory. And it's all about how the neocortex, which only mammals have, how the neocortex is the key to understanding human intelligence. And it's called 1,000 Brain Theory. And it was written by Jeff Hawkins, who started Palm Computing. And he is at a private company called Numenta, and we're an investor in Numenta. And Numenta was just on stage about a month or so ago with Intel. Intel launched their AI Everywhere strategy, and Numenta was on stage saying, with our technology, we can take these giant neural net models, shrink them down without loss of accuracy, and then we can run it on a CPU with 6 to 10 times the performance of a GPU. That is just one start of how you address the power issue. Because the GPUs eat up a lot of power, CPUs far less, but their roadmap, when you look at it, if they get to where they want to get to, then we're going to be able to have AI that is 1 million times better in terms of the ratio of intelligence per unit of power. And then, and there's several private companies working on it. And we think those are the real big winners. Because currently AI, as you pointed out, is trapped in the data center. You need a nuclear power plant to power it. What I want it in my iPhone. I want it in my AR glasses. I want all that AI local with me. And for that, you need a whole new technology base. And that's at the private level.
Which is something we talked a lot about. Let's do one more question. I'm sorry. Sorry, Doug. Doug, you're at the firm. You can ask questions anytime.
All right. Question for Mark P. Our healthcare companies have solved some of the more complex problems with vanity drugs like Ozempic and whatnot, but we really struggled with Parkinson's, Alzheimer's. How close are we to getting to solving these really tough problems with healthcare?
So I think with Parkinson's, we understand exactly what is causing Parkinson's. So basically we have, strategies to kind of supplement people with Parkinson's with drugs to kind of keep them alive. In terms of understanding what the trigger is with Parkinson's, I think we're getting there, but we're not fully there. And that's because this is probably where AI will eventually come to help, because we've got the genetic makeup of each individual's, but we've also got their history of life. And, there may be a confluence of factors that triggers it in one but doesn't trigger it in another. And that's the same with Alzheimer's. So I think we're getting there. We've already started to kind of identify some genetic types of Alzheimer's. Obviously we've gotten, those patients are more likely to be prescribed a certain way and be diagnosed a certain way. But I'd say we're a lot farther than we were 5 years ago. But I think in 5 years' time, we'll probably be a lot farther than we are today. And I suspect we will know exactly what causes those diseases, within 5 to 10 years.
Mark W., I need to talk to you later because in 1973, I wrote a paper on nuclear breeder reactors for my physics class. So we need to talk about that a little bit. But this question is really for Mark P. I'm on the board of a cancer charity, Hope Funds for Cancer Research. And some of the grants we've given out over the past few years have been to something called computational biologists. And they are looking at ways to look at drugs that are out there now or research that's out there now for a certain disease. Because when we research certain diseases, it's like throwing darts. You're picking one tiny little thing and see if it works for this particular type of cancer. And now these guys are using mathematics to say, well, let's look at these drugs that have been developed for other things that haven't worked where we thought they might work, to see if they might work in other places. It seems to me that's a place for biotech, for artificial intelligence. Is that an avenue that you see anyone chasing after?
Yeah, I mean, certainly there is some use of that. And that's because, if this target was targeted for some sort of disease in the past, and it turns out that it's actually more implicated in another disease, that's a good place to go and look and say, well, we have these old drugs that hit that target. Why don't we see if they work in this new disease? And as we understand the targets and the structures of the targets, we can go back and look at older compounds and say, well, that had the binding affinity for that particular pocket, so that should be a good place to start to do some screens. Now, typically what you'll do, though, with that is you will screen a number of those compounds that have been developed before that seem to have a specificity for the target that you've discovered now is implicated in this certain disease, and you will try that, but then you'll want to modify it because you need the intellectual property on it. Because if you designed that old compound 20 years ago and it doesn't have any IP on anymore, you'd want to try to figure out how to manipulate it a little bit. But I think that's happening all the time. I mean, if you look at a lot of diseases, especially rare orphan diseases, a lot of times those are old molecules that have been repurposed for those orphan diseases because they were known to have an effect on the body, but they didn't have a strong effect. Well, it turns out with these very orphan, rare genetic populations, they do have a very big effect. And so that's why you start to see some of these old compounds being repurposed into the orphan area.
Is AI an avenue there?
Of course it would be, yeah. Because, I mean, if again, AI would be looking at trying to determine what proteins are overexpressed for that particular disease, which of these proteins is the most likely protein to be implicated in the pathogenesis of this disease, and then what other old compounds have a design that would most likely fit or interact with that protein that's causing the problem. So absolutely, AI has a large role in that, and people have been using AI, I think, for that, to try to think about old compounds that may have an impact in the modeling of a disease.
AI is clearly starting to play a role in drug discovery, but I think Mark and I will agree on the following. Quantum computing is the holy grail here. If you get a truly functional, fault-tolerant quantum computer, it does not exist yet, but when that exists, you'll be able to fully characterize a molecule to the point that you'll know right from the get-go, does it have any toxicity, any side effects, is it effective, does it bind where you want it to and not bind where you don't want it to? And with that sort of compute power, you can really change the game. Look, we have a 5-10% success rate from IND to approval. Maybe AI can double that, but a quantum computer could get that to 90-100%. But it's not here yet. But what we're pretty sure about is not Google and it's not IBM. We think it's going to be one of the private companies, and so watch that space carefully. But it's not nuclear fusion. It's not 30 years from now. It's probably a workable quantum computer in the next 5-10 years that will be able to do what I just said, and that is the real computational biology. Oh, for certain here. Yeah, possibly France. They have a couple of good ones. But it's going to be in the Western world for certain. We have way more shots on goal than they do.
All right, everyone. So as you can see, I think Mark and Mark really displayed their expertise and skill set in what they do. So Mark and Mark, again, we really appreciate all your time today, your perspectives. You really did a wonderful job. Thank you very much. And thank you, everybody else. Enjoy another drink. Enjoy some more food. There's actually coffee and I think some cookies over there. And thanks again for everybody for attending.
Great job.
All right.